Next, so I see you, Garage, and we should be able to, you should be able to share your screen as well. So different pace, as I said, different pace altogether on this one. So I'm going to let the Garage introduce himself and the topics that he's going to be presenting.
Okay, great. Thank you very much.
Sure, thanks.
You know, I'll first briefly introduce myself. So my background is actually all in financial markets. I graduated from Brown with degrees in economics and engineering. Did a sub minor in pre-medicine. Ended up in Wall Street. Done rotations at Goldman Sachs, Credit Suisse, primarily in equity research, equity capital markets. Worked on the floor of the New York Mercantile Exchange when that was a cool thing to do. Trading crude oil options. Then went upstairs. Have held a number of different trading roles for managing global macro portfolios with the fundamental discretionary approach as well as systematic macro. I've traded convertible bonds, convertible arbitrage, volatility arbitrage, market neutral. In the last sort of 10-ish years or so, I've been deeply involved in data science and machine learning as it applies to financial markets. I helped build the platform at State Street, which uses a lot of natural language processing and AI to connect information to events, and also, allocate assets. And last few years have been heavily involved in crypto, particularly the last week or so, given what's going on. Trading portfolios, building teams, strategies across the space, exchange arbitrage, asset arbitrage, funding arbitrage. There's numerous arbitrage opportunities, as well as directional, value-added type of opportunities and strategies as well. And over that time, one of the things that I've learned among many things is that there's different types of approaches in understanding and analyze markets. Early on, I would say, although I had a very strong quant background, probably the first, say, 10 plus years of my career was deeply fundamental, traditional top-down as well as bottoms-up economic and individual asset as well as macroeconomic analysis. And as I progressed, what I realized was that my understanding and analysis of a situation or asset class or how things were likely to move was overall, it was fairly good, but my timing became increasingly poor. And when you're trading things like volatility, in which there's a strong decay component, particularly if you have what's called long vacant positions, timing is critical, and you can be absolutely right on your positions, but you can end up losing if your timing is quite poor. And so I started, working a lot on the quantitative side, and which is part of talk about a little bit in this discussion about the time component, and then realize that perhaps there's a way to mix those two approaches, a quantitative approach and a fundamental approach, and that's in the last several years have been a strong proponent of quantamental approaches, which essentially they sit at the intersection of pure quantitative and pure fundamental, and try to use the best of both. So in that spirit, I'll begin the talk. There's a very famous trader that I'm sure at least some, if not all of you, are familiar with, Paul Tudor Jones. And it's a very interesting quote that I think is quite appropriate, not only in markets, but really generally in life. And that is the secret to being successful from a trading perspective is to have an indefatigable and undying and unquenchable thirst for information and knowledge. And given the program you're in, I'm sure you're overwhelmed with information. But I think part of that curiosity is what drives each of you, and it will pay dividends in the weeks and months to come. And it's certainly important in this discipline. What is this number? Anyone have any idea? I mean, it's clearly a fairly big number. What you think for a moment, but it's an interesting number because when I talked about this, kind of the typical answer is, okay, maybe it's number of atoms in the universe, number of grains of sand, on the planet, things of that nature. So what it actually is, it's the number of legal board positions in the game Go. Now, if you think about that, it's an extraordinary number of possible positions. It is actually greater than the number of atoms in the known universe. Now, why is this important? Because a few years ago, but a little over 6 years ago, there's an AI program called AlphaGo developed by Google's DeepMind subsidiary, and it defeated the human world champion of this ancient game. And and perhaps you've done some of this in your coursework, when you construct essentially algorithms to mimic game behavior, the traditional approach is to go over, have the algo go over a number of different possibilities, and which is fine for games in which there's a small number of potential outcomes and potential pathways. But when you get into these type of numbers, you couldn't possibly go through each potential sequence one by one. It would just, you wouldn't be around to see that, even with extremely fast computers. And so it necessitated a different approach, and in things, and perhaps you've done some of this in the AI space, things like constraint optimization, different ways of bracketing AI approaches. But it's interesting because it kind of gives you some sense that a well-constructed algorithm can be extraordinarily powerful, even when the number of potential possibilities is well beyond what we can conceive. Now, there's been many advances over the years, particularly in AI, and your money talked about some of the applications to financial risk management, asset allocation, understanding credit risk, things like that. And the interesting thing from this sort of development over the, it's really been in the last like 6-7 years in which there's been strong applications of things like reinforcement learning and its application in markets and other areas. But it's the ability to learn obscure patterns and adapt and develop new strategies to ever-changing circumstances. And it's critical. I mean, we do that, as humans, because we have a very strong and well-developed, neural network in our minds. But to replicate that using machines is actually not that easy. Which is why Tesla, as great as a company it is, to this date hasn't mastered self-driving. It's far more complicated and nuanced than it appears on paper. Now, that's sort of the machine side, the strength of machines, the strength of quantitative approaches. Now, the other side is there's an interesting experiment done by Professor Jacob Scherson at Aarhus University, and what they had is they essentially had this game in which you had to find optimal solutions to a very, very difficult problem. And the idea is that, could we sort of mimic some of the way, quantum algorithms, work and like how they would work, how they could be replicated, and were humans any good at it? And what they found is that, most humans, perform poorly in this sort of optimization game. But one part that was actually quite interesting is that there were people who would actually come up with solutions which were of much higher quality and shorter duration than any algo could. Now, the question that they were wondering was like, wow, like how is this possible for very complex tasks and when there's an optimization component? You would think machines, by their very nature, can iterate through extremely quickly and would find optimal solutions. But so what they realized is what the critical sort of learning from this experiment was that humans have a very interesting ability, and interesting is probably the right word, but to forget and filter out information, and then almost begin again. Kind of when we say, okay, you're working on a difficult problem and your current approach isn't working, you take a step away, go for a walk, and the idea is to kind of clear out one's mind and approach something with a fresh set of eyes. And that particular ability is not easily translatable into code, even the way we structure it. But it tends to be, so far it seems to be a very human characteristic, which is invaluable in these types of situations. Now, speaking of quant, so that's that's the kind of the interesting human insight. Now, on the quant side, what we've seen time and time again, no matter what degree of expertise one has in quantitative finance, and the type of teams that get built by funds like Renaissance Technologies, which even with its numbers of up and downs, has had an extraordinary track record over the last 30 plus years. Firms like Two Sigma, like very, very strong quantitative team, and the best and brightest really in the world. Even then, these funds can perform very poorly from time to time, despite the best risk management algorithms, constant dynamic optimization, constant risk allocation, understanding individual factor risk, counterparty risk, on, and yet they can still have tremendous drawdowns. And a common question is, despite all, essentially you have the best people working on very difficult scenarios, and yet being able to test them, retest them, how could they still do poorly? And so that it's an interesting question, because we see it happen time and time again. We're currently seeing it happen even right now in the crypto space with what's happening with FTX. Like a number of extraordinarily well known and well recognized risk management firms have done really poorly because of what's occurring, despite great understanding and great granularity of understanding of the space. And one of the it's just an expansion on that a number of firms did really poorly. At that time, Two Sigma had lost 11.5%. Renaissance had lost about, I think, 25% that year. So all of these great quant firms did really poorly.
Garage?
Yes.
Yeah, just one question. Can you put that slide back that you showed with the Two Sigma? Yeah, that one. I mean, I see at the bottom it says that this move, I guess you're looking at 2008 here. The 15 Sigma, or one which normally would take place every several billion years.
Yeah.
But when you say, well, when they say that, but it's based on current statistics,
Absolutely.
right? I mean, assuming that all events are independent from each other. I mean, yeah, it looks like a huge number if you assume, if you believe normal distribution and all that, but
Absolutely.
maybe we're calculating it the wrong way.
Yeah. And that is fundamentally in these type of risk models, they typically assume identically intervallic distribution, distributed outcomes, typical IID, as well as normal distribution. But we know in markets, there's a high Hurst exponent. There's memory within prices and as well as correlations. And most standard approaches, even at very sophisticated, deeply quantitative firms, typically use very basic, I won't say basic, but sort of first and second level understanding of how different asset classes interact and whether there's memory. Because if you look at it a bit more sort of sophisticated way, that it is these type of events occur. The fat tails are far more occur far more frequently than traditional normal distribution approaches would suggest, and so therefore the probability of this occurring is much higher, and it's really not a 15 sigma drawdown. But most don't do that, and then there's a lot of reasons. There's sort of institutional cohesion around approaches that are simple to understand, which is the whole whole other topic. But you're absolutely correct.
Okay, just wanted to. Okay, so obviously we're reading it wrong. That's for sure, because it's 2
Yeah,
billion is a ridiculous number.
Yeah, absolutely.
Okay.
So on the other, quants certainly have challenges, and on the other side is fundamental discretionary PMs. The typical group setup is that decisions are made without a consistent framework or theory or reasoning, and there's a lot of reading that gets done, interaction with other analysts, PMs, and then there's essentially a sort of groupthink developed when you're interacting with other PMs. A set of people you talk to may be getting long bonds because they believe there's a shift in inflationary expectations and Fed policy, and so behavior tends to get mimicked. It doesn't, and that tends to work, for different periods of time, but it also creates essentially high correlation across PMs within a firm, but also overall because of this type of interaction, and it doesn't, it ends up creating um, portfolios which perform well for long periods of time, but then have essentially blow up because of the high correlation, not only within strategies, across strategies, but also within the assets within these strategies. And so, so why Quantamental? I mean, so we've, it's, fundamentally like we're kind of when I looked at it and we've looked at it both from the fundamental and quantitative side, we realized that it could potentially be a way of increasing information efficiency by combining the quantitative fundamental and behavioral approaches. Now, the behavioral approach is kind of interesting because uh, what we've realized, and I'm sure you've seen in your own lives, that the amount of information that we see come across our purview is increasing daily. It's called the typical the 3 V's of big data, volume, velocity, and variety. And it's way, it's far too much for any one individual to process. And so that's where we're seeing increasing use of machines to essentially, classify information and, natural language processing. There's a lot of work on that in sentiment analysis. But also, things like graphical networks, like Neo4j, can we connect, which is with the way that, if you think about this, the way we typically think about the world as humans. I mean, there's sort of a network type of thinking that goes on. And so is there a way that we can understand the behavior around huge amounts of information and essentially condense it and be able to relate it to markets and other areas as well? And in that spirit, when we looked at, how does the mind actually think? And in the typical sort of breakdown is the right side brain versus left side brain, and the left side tends to be thinking in the past and the future, and the right side tends to be thinking in the present. And there's a lot of work done in this space by not only psychologists but neurosurgeons, things like that. And this goes back years. And like, why is that interesting? Because with the human brain, if the left side of our brain is the past and the future and not the present, the left brain tends to be very sequential. So we process information really very slowly, 16 bits per second. We're analyzing, we're judging. It creates habitual behavior. It's the analytical side, which you use to solve problems. And when you're coding and working on problems, and you're actually in the trenches trying to figure out stuff, that's the left side of your brain being activated. Now, the right side is where actually it's quite interesting because of the focus on the limbus, thalamus, hypothalamus. The processing speed is enormous. 500,000 to 3 million bits of information per second. That's the behavior that it controls the behavior when we're not consciously focused. Sort of like when we're daydreaming, or when we have sort of bursts of insight, the visual feelings, the imagination. There's a really good book, and I reference it here, Dr. Williams. It's on trading psychology, which goes deep into this area. And why is it important? Because regardless if we're quantitative or fundamental in our approach, fundamentally, clearly, there's a behavioral component to the way that we process information, the prism through which we view information and translate that into decision. From the quantitative side, we're making decisions as to how to construct algorithms. What are the inputs? What are the parameters using? If we're using an ensemble approach, what is the sequence we want to do things? So we're imposing our sort of worldview, our understanding of how information interacts and what are the outcomes we're trying to achieve. And and it is behaviorally driven, as quantitative as it can be. You'll notice even within teams, I see this often, that I'll give a specific set of instructions to essentially code something with the particular set of output. or outputs to be expected, and the approach, it can be very different among even two people with similar training. And it's driven in part by these type of experiences, this sort of the behavioral component. And fundamentally, the way it kind of resolves in markets is we're trading our own belief system. The behavior, ultimately, what we really want to do, we want to drive our behavior so that our approach is in alignment with what's happening in markets, the actual structure, and that's important because there's sort of four phases of understanding. There's greed, confidence, self-preservation, and when we're actually having fun. And each of them are driven by our individual behavior, and we translate it into whether it's a quantitative approach or a fundamental approach. It's almost agnostic to that, but it's that behavioral component which is critical in that translation. And that is one area which is typically not addressed in there's not like a school of trading you go to, or a degree that you would earn in portfolio management. You kind of understand that you over a period or some period of time, but in that process, what typically is not addressed is this behavioral component, which over my career I've realized is as important as understanding the fundamental nature of assets or markets, or the quantitative approaches, no matter what type of algorithms we're developing, or numerical optimization approaches, et cetera, et cetera. And what it ends up resolving is, if we can understand our own behavioral structure, we have a better shot at understanding the market structure through the prism of fundamental or quantitative approaches. And so if we bring those things together, what we're ending at, what typically gets done in sort of most approaches is there's the fundamental macroscopic versus the microscopic, alpha generation. Macroscopic is essentially factor-based strategies. I'm sure you're very familiar with them, and they're quite common across firms. And there's been quite a bit of literature developed over the last really 30 years, or actually even longer than that, in this space. Whereas a microscopic, we're looking at the actual sort of nitty-gritty, the data sets, supply chains, geolocation data, the different ML techniques we're using, the vendors, and both of those are also important when we're looking under the umbrella of quantitative versus fundamental approaches. Now, traditional quantamental approaches is you're taking long, a huge universe of assets, and either applying factor baskets or screening them. And you develop different portfolios. Maybe you want to tilt it momentum based or value based, whatever the case may be. That's the tradition. It's a tried and tested approach, which generally for passive strategies has performed well. There's it's kind of, the market regimes change over time, so they get stressed, but over long periods of time, it's generally been pretty decent. And the emerging approach is a bit more nuanced, which firms such as some of the ones that are currently well known are using a lot more algorithms, a lot more different sets of data, and try to combine those two, going well beyond sort of the traditional factor-based approach, as well as understanding behavior, and then having individual teams. So the typical setup for the quant state, sort of a quant group, is you've got data curators, feature analysts, strategies, portfolio oversight, deployment, and back testing. And these are essentially set up at pods. We do it this way so that each individual pod is focused on one specific area, and it reduces this behavioral, it reduces the impact of sort of behavioral overlap across different pods, because of the different types of experience that each individual pod, the members in each individual pod would have. Now, this is Dr. Marcus Lopez de Prado, in his book on advances in financial machine learning, which is another great book that I would recommend. Has a strong discussion as to why this type of pod approach is particularly effective in quantitative settings. from the behavioral side, but also it reduces quantitative biases, which can set in each individual section. So an individual who's like, let's say very good at understanding the weaknesses and strengths of back testing, we don't necessarily want that type of understanding to filter into the optimization side or the alpha generation side. And so there's value in sort of separating these things. I mean, most, at small funds, one person will do all of these, but on, as you get larger, it makes sense to kind of separate these. So, ultimately, what do we end up doing? We combine these three aspects of decision making: quantitative, fundamental, and behavioral. And the net result is we end up combining the strengths of machine, computational efficiency, abstract pattern recognition, with human, strength, which is lateral thinking, imagination, creativity, and behavioral understanding, like thinking in the present. We always hear, stay in the here and now, let go. But it resolves in increasing in informational efficiency, combine vast arrays of data, stronger fundamental hypotheses, but increased cost savings. When we have this bespoke structure, particularly database structures, things like Neo4j, we can bring together the best of each of these elements, and that tends to be very good.
Garage, hold on. You said something. Wow. So basically, what you're telling us is, okay, fine. You could have your algorithm. You could have your understanding of the market. You could have a great, powerful computer. But I guess what you're telling us is we need a psychologist in the room as well.
Yes.
and you're right, frankly, because look what's happening in the market, yesterday.
Yeah.
Or Monday. Wait, this is crazy. This doesn't make any sense. And you're right. No one actually, I don't think so, actually does that. Have someone coming in and thinking, yeah, well, okay, this is what historically the behaviors that they've had. But how do you understand what people are going to be? You can't go and analyze the brain of every single trader out there to see what it is, how they think. Although you could, I guess you're telling us, well, we kind of all think the same, so you should understand how we think.
Yeah.
But how do you do that? How do you?
Well, fundamentally, what absent the an in-house psychologist, to work on this with each individual trader, which is what some of the best firms have. They have an actual in-house person, professional dedicated to essentially helping each trader gain clarity in their own thinking. But these are things we can do on our own. And there's a wonderful book, and I think here it is. So it's called Drawing on the Right Side of Your Brain by Betty Edwards. And I think when we had the talk on geometry of time, I mentioned this. But it's a type of resource in which what we're really trying to do is trying to ground our thinking. And when the way you ground your thinking is you essentially want to activate the right side of your brain, and that is what when athletes are in the zone, when that flow state, it is that state you want to be in, and that's critical, particularly in the program that you're in, like when you're working on some assignment which is really difficult and requires some insightful thinking. That insightful thinking comes from the right side of your brain. And so we as individuals can activate it if we don't have the help of a professional.
Okay. Well, yeah, these are interesting. Okay. Wow.
And that's my contact information if anyone wants to chat further.
Okay. Wow. This is interesting, actually. I mean, zero knowledge is one thing. But this is another thing. That's what happened when you, okay. So, thank you very much, Garage. I probably want to get back to you on